Welcome to Raising the Flipping Bar, the go-to podcast for aspiring and seasoned real estate investors. I'm your host, Derek Marlin, and I'm the CEO of Elevation. We're a real estate investment company based right here in Denver, Colorado. We'll dive into smart investment strategies, market insights, and essential tips for scaling your real estate ventures. Whether you're making your first investment or your 100th investment, this podcast is your blueprint for success in the ever-evolving world of real estate investing. Get ready to elevate your real estate game and begin your journey with me. Hey everybody, welcome back to another episode of Raising the Flipping Bar. I've got Kevin Amolsch from Pine Financial with us for a second episode. We're just having such a great conversation. I didn't want to cut it short. So we're going to dive into some great strategies of how to build your business, how to build yourself from a personal development perspective. If you didn't listen to last week's episode, you got great information on the housing crash of 2008, some great investment tips that are prior to what a lot of people have. So go listen to that one first. But Kevin, welcome back to the show.
Derek, I'm so happy to be here. Love the office, by the way. I know I just said that in the last episode, but this is great.
Thank you. It's fun having you in studio. I kind of want to talk a little bit about really the Denver market too. We talked a lot prior episode of 2008, where your career came from. You've seen a lot of stuff that other people haven't seen. So again, they need to go back and listen to that. But you really saw the kind of the foreclosure crash real time. Tell me a little bit about, we saw the crash. You and I talked when we got together and had a cold one before this of why we don't think there's going to be a crash. Tell me a little bit behind why you don't think so, maybe some data points of there's some similarities, but it's different.
Yeah, I wish I would have known or thought that you were going to ask me that because I could have looked up the statistics, but there's something like 11,000 listings in the metro area.
You're spot on.
Okay. There's like expert economists that say we're 50,000 units short of where we need to be at neutral. Okay. So it's staggering how undersupplied Denver is. I know that the months of supply has crept up over 2 months, I think now, just slightly over 2 months. Yeah. But I'll tell you, I really love the months of supply statistic. It's one that I follow because it accounts for supply and demand. So for the listener that doesn't understand months of supply, if you were to stop producing anything, there's no more new listings, no more inventory coming on the market. How long at the current transaction rate will it take to get rid of everything for the last house to sell? That's the months of supply. So now I'm looking at absorption, which is demand, and I'm looking at the supply. So I'm looking at both sides. That's the only statistic that does that. Yeah. That's why I think it's so important. Somewhere between 4 and 6 months, different experts will tell you different things, but somewhere in that range is neutral. No advantage to the seller, no advantage to the buyer. Right. So there's like really no pressure pulling houses values up or down. Sure. Right. Okay. So that's neutral. Yeah. We're around, like I said, around 2, a little over 2. So that's definitely a seller's market, which means houses should be transacting faster and prices should be increasing, which is exactly what we're seeing. Yeah. I know it's pretty stable here, but we have seen appreciation of around 2% year over year. And that's in a market with high interest rates, 20-year high rates, and a lot of fear, elections, all kinds of stuff, right? And we're still seeing home values increase. So that's the statistics side of it. Okay. Now, we talked on when we were having beers, we have record equity. I think this is the catch-all, save-all. We're not going to see a crash because when you have equity, you have options. You could refinance, you could pull cash out, you can catch loans up, you could sell. You don't have to just turn the house over to the bank. Now, we have high equity because when you have low interest rates loans, like 3%, as we've had, a lot of your monthly payment every single month is going to principal. Right. So your principal reduction is much faster than you would get if you bought a house today. Right. Okay. 1. 2, you had double-digit appreciation for multiple years because of the government stimulus. Yep. $6.5 trillion of stimulus. What do you think is going to happen? Other than inflation. So yes, we saw price values go up. Right. And then the third thing is the credit availability, which we talked in the last episode. You're not getting those liar loans anymore. People are having to put money down into properties. So they have down payments, faster reduction of principal, and rapid appreciation. So now we have record equity.
Yeah. And I think that what I'd love to kind of get your take on too is you set the stage perfectly for why we don't feel like there's going to be a crash in Metro Denver. And I agree with every data point. And I think something that I remember seeing here in the last couple of months, and this is more of a shout out to Lon over at your castle, is that only 3% of folks that are behind on their payments or have some sort of distress coming down the pipeline have less than 30% equity. So even when you're theoretically in probably one of the worst states possible of, oh shit, what do I do with my house? You still have 30% equity. But back during the crash, everybody was underwater. So that's why people just walked away. They're like, here's the keys.
That's right. Yeah. No, that's exactly right. And something that nobody talks about, and this is what I mentioned to you over beers too, we have super high interest rates, right? You have 20, 23, 24% interest rates on credit card debt, which is the number one consumer expense or consumer debt expense. And you have higher credit card debt than we've ever seen before. If you see that chart, well, maybe we throw that on here, we edit it in, but it is staggering and it's scary. But what we don't talk about, Derek, is that we're making more money now than we ever have. And we have wage inflation of over 4%. Now we have a target inflation of 2%, and we're getting pretty damn close. In fact, if you take a 6-month inflation instead of year over year, we're under 2%. So we've already hit the target. Yeah. So we're under 2% as of right now with wage inflation of 4.1, something like that. Yep. Fact check me. Yep. But it's twice. Yeah. We're increasing our income twice as fast as the cost of our expenses, our food, our everything else. That consumer debt is affordable. Those mortgages are affordable.
Yeah, you're right. It's not fun, but people aren't going into financial Armageddon. Well, and thinking through that, if we've got kind of this base of stability, it's not going crazy. It's not the 10 to 12% appreciation like we saw, but we've got this base of stability. Where would you advise people flipping properties and investing? What should they do moving forward? I know that's a loaded question. Everybody has personal strategies, but if you took it just from a global perspective that we've got some financial stability, we don't think a crash is coming. Most people just are, paralyzed by fear. Where would you advise people to kind of get back in the game or keep going?
Let's talk about this. Because what I would love for us to do here, Derek, if you're open to it, is to actually, instead of an interview style, to actually go into a conversation, because I think you have some great insights here as well.
Of course.
My thought is, look, you're buying and selling in the same market. Mm-hmm. Fix and flips are typically short term, and the market doesn't move. The real estate market doesn't move that fast. We're not talking about stocks where it's going to drop several percent a day, right? So it's very slow moving. So you're buying and selling in general in the same market. That's being said. So timing, I don't think is a concern. Now, location might be, although I don't think so with low inventory. Let me give you an example. If I'm going to buy, so we're on Broadway here, right outside this window, I'm looking right at it right now is Broadway. It's a very busy road, right? There's a median, there's stoplights. I could hear the traffic. So if I buy a house on this road, it could decrease the value of that property significantly because no one wants to live on Broadway. But what if I have no houses to choose from? What if this is the only house for me to choose from because we have such low inventory? Well, now maybe I am willing to buy that house, right? So that holds the value of that real estate up, even with that negative influence. Now, if we had a lot of inventory and I could choose lots of different houses, chances are I'm not going to choose the one on Broadway. Yeah. Right. So that really brings the value of that house down. So the inventory does have an impact on the value as well.
Yeah, well said. No, we completely agree with that statement that you just made. And I think supply and demand is such a key factor. And actually, we saw it for the good and for the bad. And I'll mention the bad first, that we just got out of a Sloan's Lake flip, where at that 3 or 4 month microcosm of time, there were a lot more options available between $1 million and 1.5. And so they were able to shop. And we were in a weird situation where we were only 4 homes off the lake. So you had this beautiful view. The location was great, but there was an insane amount of construction, of new construction. So people are like, you know what? I don't want to mess with that. And then it was weirdly a really big house. And so a lot of people said, you know what? Higher heating bills, higher costs. Maybe I just want something a little smaller that was 300 or 400 grand less. Interest rates went up. So it was like, oh, all these factors kind of created to it being a shit show. But then conversely, to your point of supply and demand, when you're the only property on the market, and that's why sometimes we'll list stuff in February and March because there's so little inventory to choose from, and it's a perfectly fixed up house, you get the $50,000 over asking. So I agree with everything you just said.
Great. So what do you think in a market like we're in now? And we didn't talk about interest rates yet, but we don't think there's going to be big shifts in interest rates. Yeah. And I could explain why I believe that. But so it's pretty stable, right? We're not going to see a bunch of appreciation on homes. We're not going to see interest rates moving a whole lot. It's going to be pretty stable, I would guess, for the next couple of years. Yep. What would you suggest? Where should we be looking?
Yeah. So for us, we feel like this is similar to 2018 to 19. Meaning still slightly sellers-based market. So if you get the right property for the right price and right location, you should fix it up well and you should sell it fairly quickly. But there's at least more inventory to choose from. So it's not like COVID where you brought up that stat and it's funny you said that, you are spot on. And we literally just recorded before this a Q3 market update and had a lot of those statistics. So this will be like perfect for the listeners to listen to. But in COVID, I remember seeing it and I thought it was a typo where it was January, I believe, of 21, because things had shut down and then they had, not that they had reopened, but we knew that the world wasn't going to end and we were allowed to sell and show homes or whatever. There was less than 1,000 homes for sale in all of Metro Denver. The supply of inventory was 7 days. And you're right, it's 2 or 3 months right now. So of course, every property went bananas and sold for way above asking. It was so hard to get a deal. People had to overpay and everybody got bailed out by the market, in my opinion. I'm actually more bullish with, let's call it a healthy investor market, where you're going to do good volume, good transactions. You probably won't hit your home runs, but if we can hit tons of doubles and we can feel a little more safe about them, I think that's a better way to build your business anyways. And that's what we're doing.
So I was talking to Scott Trench not long ago. And if you don't know Scott, he's the CEO of Bigger Pockets. So I was in his office and I was talking to him. He said something so like enlightening to me. Derek, he says this: for the last several years, the dumber you were or the worse of an investor you were, the more money you made. And his point was, if you're a terrible fix and flipper and it takes you forever to fix up a house and your appreciation was so strong that it overcame all the extra holding costs. So you actually made more money by doing a terrible job.
Right.
That's gone. You guys, those days are over. So we're not accounting on appreciation anymore. You really need to run your numbers. And what I'm seeing the successful flippers doing, tell me what you're doing, they're stress testing these numbers. Yeah. So what if I have a 2 or 3% decrease in my ARV after repaired value? Is it still profitable? Maybe I'm going to stress test 5%, whatever it is. And then that's how you go in with your offer. Because there is a chance, I don't think it's going to happen, but there is a chance to see softening.
I completely agree. And it's funny you mentioned that. We're actually redoing our deal analysis spreadsheet that we'll be releasing here in the next month or so and doing those 3 different scenarios. There's your typical case scenario, which is where we had run things and you need to be competent and confident that you're going to be able to sell it where you need to sell it. There's, again, I'm going to use air quotes, worst case scenario, meaning everything goes to hell in a handbasket and you sell 50 or 100 grand less for whatever reason. And then there's the unlikely, but the best case scenario. So you're right. You've got to stress test things. And I think that's the way we need to look at it, which is kind of the way we did it from 2015 to 2019 anyways, before the world went insane in the housing market.
Look, we're spoiled, man. We are spoiled. We didn't have the fiscal policies like back before 2008, like we have now. So we've been since 2000, call it 10, 11, somewhere in there. We've seen appreciating real estate ever since. Yeah. There was a little blip there from COVID because people are freaking out. But by and large, it's been increasing that entire time. People aren't used to this steady or down market.
Yeah, you're right. They're kind of just thriving in volatility, whether it's good or not.
Houses always go up in value. Don't worry.
Yeah, of course. Dealing with hard money lenders is the biggest headache real estate investors have. I thought that's just how hard money had to be until I met Backflip. Backflip is changing the lending game by actually making loans stress-free. And I know this firsthand because I personally use them for my own deals. Let me tell you, their free app makes real estate investing effortless. With just a few taps, I can apply for loans tailored exactly to my needs, whether it's low interest rates, high leverage, or even deferred payments. The best part, I can secure financing in less than 2 weeks, making it easier to scale my business and close more profitable deals. But it doesn't stop there. Backflip instantly provides all the data I need to estimate profits, including a curated list of high-quality comps, saving me hours of work. Unlike other lenders who disappear after funding, Backflip is a true partner for elevation. Their team is always just a call away and ready to answer any questions and offer support. With Backflip, you get the data and the cash you need to jump on good investments quickly and with confidence. Click the link in the show notes to download the free app. Now let's get back to the show. So here's where I want to kind of pivot just a little bit is I think you've given us this great, and it was funny because in my notes I had, okay, what's your crystal ball? I think you've laid that out perfectly. The one thing I'd maybe have you touch on is the interest rates, because I think that's super, super key. So everybody kind of listen up, because I think this kind of puts a bow on our whole conversation of crystal ball. Where is it going? Yeah.
So I wrote an article right before the Fed lowered the rates this last time. They lowered it 25 basis points, right? And I wrote an article saying I would not count on mortgage rates going down. In fact, why would mortgage rates go up if the Fed is dropping rates?
Right.
Which is exactly what happened.
True.
And I thought that was going to happen because the mortgage rates are not tied to the federal funds rate. This is where people get so confused. The federal funds rate is the overnight rate. That's the rate that one bank borrows from another or borrows from the Fed. Okay, that's what they pay. True. So now your car loans, your credit cards, that simple consumer debt will go down with interest rates going down. But mortgages aren't based on what the banks borrow money at, guys. Mortgages are based on a treasury plus a margin. So if you look at the 10-year treasury and you look at 30-year mortgage rate, it is almost exactly correlated. Yep. There's a little spread that goes up and down. That spread is your margin. So when you're looking at mortgage rates, what could possibly happen to mortgage rates? We have to look at two things. What's going to happen to the 10-year and what's going to happen to that margin? So let me explain the margin so that people understand that. The margin is the 10-year risk-free. We call it risk-free. So if I'm going to go long-term investment, fixed income investment, that the gold standard is the 10-year treasury. Risk-free. I can't lose my money unless we're Silicon Valley Bank, which we could talk about what happened there too. Yeah. But if you hold it for the full 10 years, you're not going to lose money. Okay, it's guaranteed by the government. So if I buy a mortgage, let's say if I buy a mortgage, I am taking a little bit of risk. It's still fixed income and it's still long-term, but it's a riskier loan. So I have to be paid a little bit more than I would pay on a risk-free. Sure. So what is that risk worth in a return? That's the margin. Yeah. So to give you an idea, the margin 1.7 is the long-term, like 50-year average, 1.7%. We're well over 2% margin right now. It's like almost 2.4, I think. Yep. I'm throwing out all these statistics, and I didn't check any of this before we recorded, but it's right around there.
We'll fact check you, but you're close enough.
I'm pretty close on that. And one of the reasons for that people don't understand is that we are expecting a refinance boom. So when the rates do start to come down a little bit, and we've already seen it, guys, but when we'll see refinances happen. So if I'm going to buy a fixed income that might be paid off, I get all my money back, then that's not a good investment for me, right? Because I want the long term. So to compensate me for that, I need a little bit higher return today. So I think that's why we're seeing the margin stay elevated in this environment. Now, the 10-year trades on supply and demand. And here's the problem. You want to freak out, you guys sitting down? This is what's scary. The government is the biggest Ponzi scheme in the history of Ponzi's. Okay, so the government issues 10-year treasuries and all these other treasuries, and then that's debt. They have to pay interest on that debt, but they don't have enough income to pay the interest on the debt. In fact, our debt expense has surpassed military spending. This is a big issue. So how do we pay our interest on our debt that we've taken out if we don't have the money? Well, if we're the government, we just issue more debt. That's why I call it Ponzi. So they're issuing. Yeah. Okay. So when I flood the market with 10-year treasury bonds, and I need people to buy those, I need China and Japan and others to buy these bonds. What do I have to do to incent them to buy them?
You've got to pay a higher rate.
I got to pay a higher rate.
Yeah, pay a higher rate.
So that's why we're seeing a higher treasury, even when the short-term Fed funds rate is coming down.
Well, and I think you said that perfectly, because we're also slowly drifting down over time in the next year or two, but just to historical rates, kind of historical norms. The way I always say this is, if we get down to 2s or 3s again, Armageddon has already happened. Everybody's already lost their jobs. Like, there's a whole nother set of circumstances that we're screwed on. And you're, other than maybe some very, very wealthy people that can just deal in cash, you're screwed anyway. So you don't want that, ironically, in my opinion. I mean, it's nice to have super cheap debt, but this kind of median historical norm, if you're good at your business, is where the sweet spot is. We just got to be good at our businesses.
I 100% agree with you, but anyone who's been looking at this the last 20 years won't agree with you.
Okay, tell me why.
Because the interest rates are higher now than they've been in the last 20 years.
Okay.
Now, if you look all the way back to the 80s and before all these fiscal changes, then you're right.
Yeah.
But over the last 20 years, it is higher now than it's been.
That's true. No, that's definitely true. So it'd be nice to obviously have it kind of trickle down, but yeah, it'll be interesting to see where it goes. So no, this has been great information. And I love the data and the context, because that's how we try to base our decisions on it. But I kind of want to pivot to one more thing before we wrap up, because you've been so generous with your time. And this has been such good information. Again, you guys got to go back and listen to the first episode. It just puts this perfectly into context. Okay, you've got all the data that you talked about. You've got running a great business. From a personal development standpoint and an education standpoint, I think that's a key piece of the puzzle to put this all together. So tell me a little bit about kind of what you do from a personal development standpoint, how you're educating people. And I want to talk about your Investor Success Summit, but just kind of round this out, because to me, those are the three big pillars to success.
So I'm going to be interviewing Scott Trinch. I know I already brought his name up once, but I'm going to be interviewing him on stage at the Success Summit on November 9th.
Oh, nice.
So I'm like, I got to prepare for this, Derek. I got Scott Trinch. I'm going to be in front of 300, 400 people or whatever. So I'm re-listening to his book, what is set for life. And I just on my way to this podcast recording, I was listening to the chapter of this.
Okay.
It's just constant improvement. It's got to be a constant improvement, and then you'll have a compound benefit. So your education, like your savings account, right? Interest on interest, your knowledge works the same way. So if you're constantly improving, you will grow exponentially. So I think reading is vital. So I mentioned earlier that, I guess at the last episode, that a morning routine is pretty important, and exercise in your mind should be part of that.
Right.
I think reading is important. So 30 minutes, even if it's 15, 20 minutes a day, read. But if you're not investing in yourself, you're going to fall behind. There's no investment, Derek. We both love investments.
Sure.
You and I, we go out there and we're looking at different things. I'm looking at this beautiful office and how you've been able to turn this around and make money doing it. This is an investment for you.
Sure.
The investment that I wanted to get to, Derek, here is, and I think you'll agree with me, is on yourself.
I agree.
That's the highest ROI that you will get. So if you're not doing that, I think you will fall behind. Now, the Success Summit, we provide, and you provide also, education for free. Like, education is really easy to get now. Right? With podcasts, with Meetup, with, Bigger Pockets, it's easy to get. Then it's implementing, and actually that's when you really learn it.
Right.
But so we like to provide education for free. Now, the Success Summit's the largest real estate conference in Colorado. And it's for Colorado investors. So it's not a national thing. It's very local, and it's not free because we have to pay to put it on.
Sure.
So we're just trying to cover our expenses. $39.
It's
basically free. We've had a lot of fun with it. I know you've been to one.
Yeah. I've been to them back in the day.
Yeah, tell me, what was your experience back when you were just getting started?
So this is actually great context because I was in sports marketing. I was in finance. I had no experience whatsoever in real estate. My wife will easily tell you that I'm shitty at remodeling our own house. I'm slow. Stuff's a little bit crooked. So when I first said, hey, I'm going to do this investment business, she's like, are you out of your mind? So what I did to kind of beef up my education muscle, as you just mentioned, is I went to everything.
Yeah.
I went to every different educational opportunity, every seminar, every training. I kind of had a personal internal kind of cutoff of, okay, I'll spend up to several $100s. I probably won't make the jump to do the $10,000 or $20,000 personal development package because I kind of wanted to figure it out on my own and create my own system. But yeah, I went to at least 2 or 3 investor success summits. And I remember it because I was working. I just left the Broncos and then I came back and I'm like, ooh, this is in the parking lot at the PPA Center. So I think that's a great way for people to get education, to make good connections, and then just keep adding on top of that. And then your sophistication level will lead to wherever you want to take your business. But no, it was a great way to go for folks kind of starting out. And then now looking back, it's a great way to make connections. So I think it's a great conference.
Yeah,
I think
did
it's
you
a
meet
great
anyone
conference.
there that you connected with?
Oh, absolutely. Yeah, definitely. I actually kind of took another step where I met a guy who was teaching at Arapahoe Community College and took his community college course. So I took Real Estate 101 and 102. And then from there, just took a bunch of other courses. And now it's ironic because we teach this stuff ourselves. And it's kind of this love child of finance, sales and marketing, and real estate investing. So no, love the Success Summit. I guarantee I probably listened to you on stage. So it's weird that we're here, whatever, 10 years later at the same podcast table.
You mentioned early on in the first episode that about your why, and we were talking about goals and that kind of thing. And one of my whys is to really give back and help newer investors like yourself 10 years ago.
Yeah.
And then sometimes I'll get these little letters, like handwritten thank you notes. And it's so amazing. And so we posted that in our office, and I walk by that every single day. And so that to make that difference, that's a why.
That's really, really cool. Oh, man. Well, I've taken up so much of your time. I kind of want to hit just one little last thing because you and I had this interesting conversation offline, and this is a little bit full circle. So you talked about your why. People are doing their investment journey, but precursor, you and I both have kiddos that are in the high school, college age. And I've asked this for a couple of different guests, and you're the perfect person to ask. Just tell me your thought process on, I'm going to call it college ROI, of whether people are thinking about university or college, trade schools, military service. Just give me your general overview of kind of where you're at. Again, every family is different. Every situation is different. Some people can write that college check. Some people can't. But to me, I think we have to analyze, is this the right move for people? And I'd love to get your college take, because it's almost like we could rewind it and put that at the beginning of the episode.
Dude, this is a hard one because you're right. Everybody's situation is different. And it's hard to measure the social benefit of college. So
True.
I almost feel like I have to take that out of this conversation.
I agree. Like that development and growing up as a person and things like that.
Yeah. I mean, someone like me that as you might not know because you saw me on stage, but I'm super introverted. To go into a room with people I don't know is very difficult for me. So, and I didn't have the college experience. I went to the military. Right. But I'm wondering if that would have changed. I have no idea, but I think there's some development that's outside the education that you get educated. But with that said, man, I've seen some statistics from 40% and up of college degrees have a negative ROI. And students leave these schools with 6 figures of debt that they can't pay off. Right. And you can't bankrupt them. I mean, they're going to follow you for, however long it takes. Mm-hmm. Now, I happen to love student debt because it's low interest and it's tax deductible. Yep. So I used it to buy houses. I had the military pay for my school, but if you're going to give me money at 3 or 2%, I'm going to take it. Yep. But if you're taking money at 2% and you're buying something that's not going to benefit you, I think that could be a problem financially for you. Yep. And so my opinion, and I think you agree, if there's a specific goal in mind, you want to be a doctor, you want to be an attorney, you want to be something like that, then I think college is probably the right path. If you don't know, or you want to be an entrepreneur, you want to be a real estate investor, you want to be a plumber, I would encourage you to look at that strongly and consider maybe a different path.
Yeah, no, I think that's well said. I think everybody really needs to have that personal reflection, both as the kiddo and as, family member, mom and dad, support system, whoever, and make the best, choice for you. But it doesn't have to be immediately just going on to a university where you're at. You can't pay that debt off anyway. So
you don't have to go at 18, guys.
Yeah,
you can go out and get a little bit of experience in the world and try to get some more clarity around your life and then go. Mm-hmm. There's nothing wrong with that.
I think that's well said. Well, man, Kevin, thank you so much for joining us today. How can people get in touch with you? How can they connect with you? I want to be able to make sure to get all your contact info out so they can connect with you.
Yeah, that'd be great. So the Success Summit, that we would love to see you in Denver at the PPA Event Center on November 9th. Mm-hmm. I think it's 8:30 to 5. We buy you a drink. We have a great networking event. It's only $39. It's sort of a no-brainer if you're serious about becoming a real estate or you are a real estate investor. So you can get more information at denveriss.com. So it's www.denveriss.com. Otherwise, check out our YouTube channel. That's going really well. We're having a ton of fun with that. We drop a video every single week, actually 2 because we drop our podcasts on there. So you're on the YouTube. And so that's youtube.com/Pine Financial. Otherwise, you can reach out to me directly. I still answer my own emails. I communicate very well with email. So if you want to get a hold of me, that's the best way. It's Kevin@pinefinancialgroup.com.
Awesome. Kevin, thank you so much for being a guest today. We really appreciate all your insight. Guys, I hope you got a ton out of today. If you didn't, I think we got to probably have a separate conversation. But thank you so much for tuning in, and we'll catch all you guys on the flip side. Thanks for tuning in to this week's episode of Raising the Flipping Bar. If you found value in our insights and stories, let's keep the conversation going. Connect with me on social media and be sure to share this episode with friends or colleagues who might benefit. Your feedback and reviews help us grow and reach more listeners like you. So please, if you enjoyed this episode, leave us a review. Thanks again to the Elevation Academy for sponsoring today's show. If you're interested in learning more, click the link in the show notes below. And remember, every property tells a story, every deal brings a lesson. Keep reaching for those goals, and we'll catch you on the flip side. Hey, everybody. Thank you so much for listening and watching Raising the Flipping Bar. Just a basic overall disclaimer is that A, this is not legal advice. B, this is not tax advice. C, this is not financial advice. I hope you get the gist, but I'm obviously not a lawyer, not a CPA. Hell, I'm not even a real estate agent, actually. But in general, we hope you get a ton of value out of this, but there is a bit of a disclaimer. Please consult a professional if you have any questions whatsoever. Thanks.